Tax increment financing, or TIF, has been used by municipalities for more than 40 years. It allows local governments to invest in public infrastructure and other improvements up front, then pay later for those investments. This program not only helps municipalities, but also helps developers with their project costs. Like any financial program, there's a lot of rules and regulations to understand before you can take advantage of the program. We invited Emily Blaylock, president of Untamed Equity, to help us better understand how TIF works and how to monetize TIF. Today on Small Business Talks. Tax increment financing, or TIF, is a public financing method that's used as a subsidy for redevelopment, infrastructure, and other community improvement projects. It's an effective way to stimulate development in communities, but like all programs, there's a lot to understand about it. To help us better understand TIF, and more importantly, the monetization of TIF, we have Emily Blaylock, the president of Untamed Equity, with us today. Welcome, Emily.
Hi, Neil. Thank you for having me.
Certainly glad to have you on board. I think we want to start off with, because a lot of people, listen to this as they hear the word TIF. Could you maybe just give kind of a brief overview, or, what exactly is TIF and what's the purpose of it?
Yeah, so TIF, tax increment financing, is a tool that's been around for many, many years that municipalities can use to, kind of help with other costs that come into play with developing that infrastructure for a project, or can help because things come up, like a project can have environmental issues, or there's an abandoned building that needs to be rehabbed. And there's a bunch of different additional costs that come in with that, which fall under TIF eligible costs. But ideally, it's that horizontal build of the structure. So it's your roads, your infrastructure, your water, your sewer, those are TIF eligible costs. And so when that happens, there could be additional things that the developer comes to the table and says, well, I can definitely do this project and build this new or fix up that abandoned building and bring additional value and tax revenues to the district. However, it doesn't quite work with the numbers. And we've all been there, to look at projects and understand, that can happen. And that in that case, the city can use TIF as a tool to reimburse back the developer some of those additional costs.
Okay. So the idea is to getting is the program and the way it works, and the goal that we're talking about today is how do you monetize that? How do you actually get the money out of the TIF program?
Yeah, there are generally all sorts of ways that municipalities handle TIF and using that as a tool. But one thing that we like to think about, from Untamed Equity is that we can really supercharge that TIF as a tool. And what I mean by that is that generally speaking, when I talked about TIF, the city will reimburse back the developer some portion of those costs, those TIF eligible costs, over time. And what Untamed Equity can do is come in and monetize those future increment cash flows that we know are coming in as a reimbursement back to the developer. And generally those are in the form of the reimbursement of property taxes that are paid by the developer. And then we look at that net present value cash flow stream and offer a lump sum loan amount based on a margining of that net present value cash flow stream.
Okay, because that's this is something a little bit different than what's out there, isn't it? This is something a little bit unique in the marketplace.
Yeah, and that's why I say, it's kind of, yes, the tool of TIF has been around to reimburse that developer back for expenses, but what we're really doing is adding that additional value to those payments by offering those payments to be reimbursed to the developer up front. So we can fund that gap equity. It turns out to be gap equity that comes into the project, because at the end of the day, we all want to get that project finished. The city wants that project finished, and the end user wants to use that, project or development. And of course, the developer's there to get it to the finish line. But there are ways to obviously fund that up front that we provide rather than having the city do it.
Okay, and like I said, that's unique because that's something that I know is not, it's kind of new to the marketplace on that. So what do you need to get started on a project?
Yeah, for us, looking at a project really is simple. It's a draft or a form of development agreement that the developer and the municipality has entered into. And then it's, that first draft of maybe the projections of what that tax increment looks like. So again, we're going off of those future property taxes that are going to be assessed on that project that developer is going to get and build.
Well, this certainly sounds like it's a great stimulus, because that seems like that would be one of the big headaches of doing any kind of a project is, especially when you have new costs come in and try to figure out where is this going to come from. So I think this is something that would definitely help with something. Obviously, you've thought of that. I'm just the outsider, bringing that to the table. So what is a timeline of where you fit in with the deal process? I know you mentioned it's out when the agreement's been done, but maybe walk us through, a little bit where you come into this. And
yeah, so I think, it's always varies per deal. But the best starting point is when the developer is in that draft form with the municipality. Because at that point we can discuss some nuances that are within development agreements. So today, development agreements aren't consistent across the US, and so each municipality works within their statutes, and stuff to create development agreements. So there's a lot of reviewing of that development agreement that happens. So the best stage is when that development agreement is in draft form with the developer. And there is, particularly to make it a more lendable project, there is an enhancement to add to the development agreement that we like to talk about, which is the minimum EAV, or minimum equalized assessed value, or a minimum guaranteed tax payment language that goes into that development agreement. Now that's lots of acronyms there, but really what that's kind of saying is that, hey, everybody at the table, the municipality, the developer, and us as a lender can come in and say, we all agree that this developer and the city is going to build this project for a certain value. We have the costs that go into the project, so we know those costs. Okay, we're all agreeing that the minimum value of this project is going to be, for example, $10 million. And then if we have that starting point kind of assessed in that development agreement, then we all know from an underwriting standpoint, where's that increment really going to fall on an annual basis, an increment being that property tax calculation.
You mentioned a little bit about nuances. Can you give maybe a couple examples of what would be some of those nuances?
Yeah, so as I mentioned, every development agreement kind of is different. There are a couple different ways that municipalities, can traditionally, I'm not going to speak to every way, but there are many different ways that municipalities kind of write those development agreements. And one is as a pay as you go TIF, which means that the developer and the city in their development agreement, they're basically stating that every year the developer is going to get X% of that property tax rebated back. So it's a very simplified form of saying exactly, kind of what that developer is going to get. Another form is in a TIF note, where the city is issuing that TIF note for a set principal amount. Again, that's the amount that's going to be reimbursed back to the developer. Then there's also revenue obligation bonds that a city issue. And again, these are not obligations that the city is actually, going to report on their financial statements. This is just a mechanism to be able to pay those funds over the year. But there are different nuances to each one of those and how we monetize those. But we can monetize all of those types of increment payments that come back. But some of the other nuances that I'll speak to is oftentimes TIF is granted, with the caveat of job creation, for the area. And so that is, we all like that. We all want to have job creation in there. However, I will caution that it gets really tedious if a municipality is going to say, hey, create, 100 jobs all at this salary, for the life of that development. Because at the end of the day, the lender and the developer and the city all have to report on those numbers, too, for that action item. So you just want to be cautious that, you don't create a more of a reporting issue and in what you really want to accomplish, of creating that job. So that's one nuance that we've seen sometimes.
Okay.
We've also seen, some caveats around, reaching an IRR for the project by the developer, and that means internal rate of return for the developer. And so they have to reach a certain return, and that's okay to have that in there. Again, it's just being mindful of that is what it is, and we all have to, calculate those numbers and understand what that really means. So it's one extra step in the development agreement that we want to be sure that everyone understands what we're actually accounting for, with those nuances.
Okay, thank you. What are there any red flags that would stop you from monetizing TIF? And if there are, what would those be? What are some examples of what those would be?
Yeah, so that is kind of what I just spoke to there, which is about the, if we have a set number of jobs, for example, is one red
Okay.
flag where, yeah, okay, now we're making this really complicated where we have to upkeep, and make sure, because ultimately, us as the lender in this situation, and the developer, we're both on the hook there to adhere to that development agreement. We want to make sure that that development agreement is in line and being, followed. And so some of those certifications that can come across create additional work and reporting from our responsibility as well as the developers.
Okay.
So that's one. And then the other one is if we have any clawback clauses, that once the developer reaches a certain return on their investment, that there's a clawback, from the municipality that can put some things into question, because again, we're all trying just to predict where that increment, is going to come out. And, so that can create some question marks, along the lendable side, perspective.
Can you touch base on where you have done some of these monetization deals?
Yeah, so currently we over the last about a year and a half or so, we've really kind of grown our portfolio. And so today we're in 9 states, and that would be Iowa, Illinois, Minnesota, Wisconsin, Kansas, Texas, Nebraska, Ohio, and Oklahoma. And I think I got them all, but we're in 9 states today. And, just a fun number that we've been calculating, based on project costs invested, we've helped get $450 million in economic development done.
Wow.
Across the US. So it's fun.
That does sound like fun. I got to ask you though, what have you learned from those initial deals? Is there anything that sticks out, or anything you've learned along the way that you're allowed to share?
Yeah, right. I think, the biggest thing, and again, it kind of goes back to that this is fun. We're here to, help in economic development, and that is fun to see. That is fun to get a project to completion. And oftentimes, this tool is not used enough to help get a project to completion, to monetize that and to provide that additional gap equity to the table. And so, I think that what we've learned is that TIF in general is very similar across the states. But, like I mentioned before, every development agreement is different. So there can be many different items, and as we joke in the lending world, hair on deals that come up and you got to solve, and fires you got to put out. So, you learn things all the time about, these deals, but the important thing is that we can use our expertise to basically create that consistency across the board, and across the US with this type of program.
That was one of the reasons that I was happy to have you on the podcast, is because I think there isn't enough people that actually know all about this. They hear the word TIF. I think people know a basic understanding of it. So that's why it was very important to kind of bring this more forward. and see what the benefits of it, especially the monetization part of it, because I think you're right. We're right now in times that what do we need? We need financing for, infrastructure and for, improving neighborhoods and all that, because it just seems like it's a tough road to hoe right now. So it's one of those things to kind of go through that. So I think you've already touched base on this, but just kind of to reiterate, how does monetizing TIF enhance the return on the investment?
Yeah, so, without getting into a lot of financial hat, analysis here at this point, really the point around that is that instead of, if you think about it as, when you have a deal and the developer's got to put in their own money, their own cash equity into the deal to create, that project and build that. Where TIF comes in is that it can definitely be seen as that equity piece. And that's not the developer's money in the project then. That's our partner's money in the project. And so therefore, the return on investment from the developer is enhanced because they aren't using their own money to put it in the project. They're using our partners. So over time, that gives them a higher return on that initial cash flow out the door.
Okay, great. I'm going to let you have the last few minutes to kind of summarize. I will ask one thing before we get there. Let me ask you this. If somebody hears this and they're like, okay, I want more information on something like this. Now we're going to put your web address in the description on the thing. Just a phone call, an email. What would you recommend? How can somebody get started with this?
Yeah, the best way is, again, these deals are complicated. So honestly, the best way that we like to do business is to talk to you about the deal. And so feel free to call us at any time. The number, you'll provide that as well, but it's 563-388-2555. And, we have a team here ready to talk you through these deals. But that's the best way, just because there are so many different complications.
And that would probably be my only other thing is, do you see this growing beyond 9 states? And what do you think? How is that going to, is it more of a legality thing or just a logistics thing to go out further?
Yeah, no, we are open to the US, so from a footprint wide. So it's just about making those connections and, getting out there to other states and other areas of the US right now. So we do have a couple more states pending in our pipeline right now that we're bringing on board. But yes, so we are open to other states as well.
I just thought I'd ask that because I'm sure because when I look at, the viewership or the viewership, the listenership, it's all across the country. So it's one of those things that if you see something is like, okay, let's at least, give them a way to be able to kind of contact you and be able to talk to you about that. As promised, I'm going to let you have the last word if you want to summarize or just go through everything. And
yeah, no, I think the biggest thing is this tool already exists, for municipalities to use and, for developers to be aware of. I think the important thing is to note that we are here to help and enhance that tool and make it, better for all parties at the table. So, the benefits to the municipality are that they don't have to give grant money or be, do that obligation to the developer to try and get those funds up front for that developer. That's our job. We're taking on the risk of that project, off the municipality's plate. The benefits to the developer are that, again, going back to my previous statement about the return on investment, they get a higher return on investment because it's our partner's money, not their money in the project, for that last bit of gap equity. And they get the money up front instead of waiting year after year after year, because many of these TIF districts do last 15, 20, 25 years, to get your money. And so we are allowing for them to get a chunk up front to use for any type of investment. And then most importantly, we are here to give, our creative, solutions to these projects and here to enhance economic development across the US. So please use us as experts in our area around this topic, and hopefully we can keep building more and new and changing, all those projects that need help and getting all these projects to the finish line.
That's fantastic. Thank you very much, Emily, for coming on and especially sharing your knowledge of this, because like I said, it's there's so much to it, and you've really brought it and kind of explained it very well, I think, to everybody on there. And I thank you very much for taking some time to meet with us and be on the podcast.
Yeah, no, thank you, Neil. I appreciate you reaching out as well.
And we're going to go ahead and put both the phone number and the link to the website in the description. And again, thank you very much for being on the podcast, and thank everyone for listening.